Thank you very much. Just a question before I start. Well, I was here last year hearing outlook and what the prognosis was for grain prices last year, and just got a question for the people in the room. Who forecast the Russian drought we saw in the middle of last year, or the flooding we saw in Australia at the end of last year? Any show of hands? Okay, just keep that in mind for what I'm going to talk to you about later on. So where are we at the moment in the global grain markets? Well, stocks have been largely rebuilt in wheat, but on the back for corn and soybeans, Chinese are still importing soybeans like they're going out of fashion, and on the corn side we're still seeing significant demand in the US for ethanol and mandates increasing. Oil's increasing in price, as we've particularly seen in the past 6 weeks with the Middle Eastern issues, and ethanol plants are making good money. The US dollar, it's still declining. As Winston Churchill once famously said, the US Congress can be relied upon to make the correct decision, but only when they've exhausted every possible opportunity. So, you know, how that's going to finish out, but when my father went for his honeymoon, he was getting $1.24 for his currency. So there's still potential for that currency to keep going. That's having big impacts on farm returns. And then speculation. There's a lot of money coming into the market. Do I think it's having a significant impact? No. Futures markets are zero-sum markets. For every person who buys, there's a person who's selling, and they all net to zero. But human beings trade markets, and as a result, fear and greed do have an impact. So, price predictions. And as Yogi Berra, the famous baseball player, once said, making predictions is tough, especially about the future. But this chart here, it comes from a commodity trader in Beijing with Louis Dreyfus, and basically what it's showing is corn prices from the 1870s to nearly present day. And what it's basically showing, I think, is that the old highs become the new lows when we get these supply shocks. And as you can see, we have World War I, where the old highs become the new lows, World War II, the Great Russian Grain Robbery in the 70s, and what he calls here the Great Chinese Commodity Robbery. So what are we seeing at the moment? Well, again, the old highs here in the in the corn market, around that 350. We can see we had the pullback with the global financial crisis. That's about as low as it went. Wheat, similar situation, around $5. And soybeans around that sort of $9 to $10. So I think we've actually reached a new plateau in grain prices when you look back over history. This is a study from Irwin and Good, some economists in the US, basically trying to extrapolate out where prices have been in the past and looking at some new trading ranges. Now, I don't know if those numbers there are going to be completely accurate, but probably the key point I want to make here is look at the volatility compared to what we've had in the past for wheat, corn and soybeans. So the future, well again, referring to my friend Yogi, it ain't what it used to be. The price of wheat, I'm arguing, is going to be driven more by corn and soybeans because the stocks there are so much tighter. Supply shocks, the US haven't had a drought since 1988, and we're currently in a very, very strong La Nina pattern, and I think there's a very good chance that, again, the one thing I can guarantee is that the US will have another drought one day, whether it's this year, whether it's going to be in the future, but with the ethanol mandate sitting behind there, and the tightness in stocks globally, and the fear if food becomes short, we could see some real explosions again. As I said, the Aussie dollar, it's having a significant impact on our returns. Volatility, I believe, is here to stay. And the question I'd ask you in this room, particularly the farmers, is how are you going to manage this volatility, particularly given the balance sheet risk we're exposed to with these large swings in grain prices? So let's have a look at some of the options we've got to manage pricing risk. We've got the traditional pools, cash at harvest, on-farm storage, cost plus selling, and then the derivatives market, futures and options. Pools. Can they outperform the market? A lot of pool operators will come out and say, we're going to beat the market, we're going to outperform, we've got a great pool selling program. What's the transparency behind them? What's their selling program? Are they selling a lot in the first quarter? Are they hedging? Are they using options? Are they using futures? Are they using other exotic over-the-counter products with knockouts and these sorts of things? I think for what they are, they're quite costly. And also, a lot of the risk with the pool is sitting with the grower. If we get knocked back, if we have a load knocked back because of iron filings or carnal bunt, it's not the pool operator that wears that risk, it's me, the grower. Cash at harvest, well the beauty with cash at harvest is it's transparent. You know the price, you know what you're going to get if you sell it all at harvest. And obviously, being growers with large working capital requirements, you need to satisfy cash flow needs, so you've got to sell some grain at harvest. However, if you're in the Western Districts of Victoria, in an area where harvest finishes up or you're very, very late to harvest, you can see prices fall away quite rapidly in big years when the market will basically get its fill. On-farm storage has been a big push to move into on-farm storage, and the question I'd ask is why? And the system, I believe, has plenty of capacity, and particularly in Western Australia, your most efficient supply chain is to put it into the system and put it on a boat to go export, because you don't have a domestic market. On the eastern seaboard, in some pockets, you can probably make an argument, but what is the most efficient supply chain for your grain? That's probably the point I'm trying to make here. And can you turn that infrastructure over? Can you put a summer-winter crop through it? Can you maybe use silo bags and put them through your system to dry or to aerate it? And basically, if you are going to go down this path of storing a lot of grain on farm, you really have to start thinking like an elevator. See what basis is doing, what's the market telling you with carries. There's another skill set that has to come in, as opposed to just whacking up some silos and putting some grain in them. This is a farmer I met in the Midwest of the USA, in southern Illinois. He's farming mainly in central Illinois actually, all cash rented, 24,000 acres, aiming to get to 420,000 acres. And the only bit of farm he owns is this 30 acres where he's got his house, his sheds, and his on-farm storage network, which is about 150,000 tonnes. It's all corn, and basically what he does is he brings corn out of central Illinois down to southern Illinois, where he puts it through his system for drying, because in the States you've basically got to dry your corn, and then he outturns it down to St Louis below the barrages. And he's picking up at about 40 or 50 cents a bushel doing that every year. And that's basically what's paying for his storage. Cost plus selling, if we know our cost of production, it'd be great just to say, right, well, when the market gets to this level, I'm just going to lock in a profit. The only two problems with that strategy are that A, the market doesn't respect your cost of production. So, for example, $400 a tonne is a lousy price if I'm only growing half a tonne to the hectare in a drought, and conversely, $200 a tonne is a fantastic price if I'm growing 5 tonne to the hectare. But the other big risk, and the cotton growers experienced this year, is you start scaling in and selling out, and all of a sudden the price explodes and you've left a lot of money on the table. Cotton growers who are selling their crop forward at $500 a bale, which is still profitable, but I bet you ask them today, they'd much rather be selling at $900 where it is at the moment. Futures, very easy to get into, very difficult to get out of. Yeah, obviously I've been there and done that, and particularly with the issues of over-hedging in 2006, 2007. It's a zero-sum game, and basically your upside exposure is unlimited. And again, the key point with the volatility we're experiencing at the moment, can your balance sheet sustain those sorts of movements? Options, they have an upfront cost, but I think they're better, particularly in Australia, they're better able to handle the volatility we have in production. And this is where and again, we insure ourselves for hail, fire, medical insurance. Why can't we insure for price? Why don't we, when you look at the volatility and the ranges of outcomes and the impact that can have on your business, why don't we view options a lot more favourable and say, look, if it's a premium I can't collect on, well, so be it, but it can start to take out some of these big swings. This is a fascinating book I read during my Nuffield travels, Nassim Taleb's The Black Swan. Some of you in the room might be familiar with it, but basically he's talking about extreme events and their impact, and what basically classifies a black swan is an outlier event, so it's on a distribution curve, it's way out on either side. They're extreme in their impact, and you can concoct explanations for their occurrence after the event, thus allegedly making it explainable and arguably predictable. And we had a couple of these in 2007. We came out of the 2006 drought and thought surely we're not going to get another year like that. We had our driest July to October growing season rainfall on record. We started selling grain forward at $5 a bushel, which in history had only been surpassed 4 times in the past 20 years. The all-time high for wheat price at that time was $7.20. We started buying those contracts back at $9, and it ended up topping out at $13. So it's basically going to the theory that the absence of evidence isn't evidence of absence. So how do we go and look at the grain market? We've got the traditional market analysis. You go and look at fundamentals, which I think in the long term is what drives markets. You can get into your technicals, your Gann and Fibonacci retracements and condors and head and shoulder patterns and all these sorts of things, but I think they're reasonably unreliable. And one of the beauties of technical analysis is you can make them show anything if you want. That's a black swan sitting there. And market advisors. A lot of people use market advisors, and I'd argue that they're probably not too much better than the grower in terms of predicting where prices are going to end up. So what I'm basically arguing here is that no one can consistently and repeatedly predict markets unless you're an oracle. And if you're an oracle, you might as well get out of farming and go and punt the market. And why, of all the second careers farmers could participate in, why do they think that commodity speculation is their higher calling? What makes them think that they can take on arbitrage departments in banks and hedge funds and think that they can beat the market? Markets are driven by unknown information and expectations. So this is a gentleman I met in Iowa. He's got an MBA from the University of Chicago. He used to work with Credit Suisse before he decided to come back farming. And his philosophy with marketing is that I can't beat the market, I'm going to take market average. And he sells his crop in 40-week increments over 2 years, so 1/80th of his production on a rolling basis. Why 40 weeks? He takes out the 6 weeks harvest pressure, 4 weeks at the end of the financial year for tax-motivated sellers, and also 2 weeks in the beginning of March, because that's when all the John Deere finance repayments are due, so you've got a lot of farmers wanting to sell for cash then. But rather than spending all this time poring over charts, poring over supply and demand analysis, he takes that time and either puts it into his business to try and lower his cost of production, or he spends it with his family, and I think it's a pretty good philosophy. So coming out of that, in terms of how we should be looking at managing our risk, well, looking at the finance industry, and I don't want to rave on about efficient market hypothesis and random walk, and I'm probably not a complete 100% believer in it, but probably the two key things I'd like to mention here is you look at the mining industry at the moment. They've got a lot of money and a lot more capital and skills than I do in my business, and they're all buying back their hedge books and moving to spot market sales. You look at the iron ore market, you look at the coal market, they're moving away from forward contracts, and it's all spot market. And again, that impact of people on markets, fear and greed really do drive markets at extreme levels, and I can't predict what's going to happen tomorrow on the futures market if something blows up. Again, 6 months ago, who would have thought the Middle East was going to blow up like it did, and how that can interplay on your pricing strategies. So why not consider market average? Why not look at a passive style investment program for a portion of your crop? A bit like an index fund. So you go and buy a basket of commodities like the ASX 200, the S&P, the Dow Jones, and just accept market average. I mean, again, when you look at in the finance industry, a vast majority of funds managers fail to beat the market, and they charge you a fair privilege for doing so. So this is a product with a company called Ag Farm, and no, I'm not on a retainer, unfortunately, but what this is basically showing is the variability in prices over 2009 and what the average was and what two pool operators have managed to achieve. So Ag Farm, again, they introduced this product. I think it's expensive at 2% a track, what they're charging. You can step into the finance sector and go and buy the ASX 200 and on a passive style program, and you're probably getting charged, depending on how much money you want to put into it, anywhere from 0.5% to probably 1.25%. You can undertake it synthetically yourself. You can either go and maybe use GrainCorp warehouse cash flow and then unwind that position over time. You could go to the OTC market with your bank and possibly look at a market averaging mechanism. And also Cargill are starting, in the United States, there's a product there called Pacer and Pacer Ultra, which is a market, you can nominate a time period you want to take an average closing price on the futures market each day. And they're looking at it's my understanding they're looking at bringing that product out into Australia shortly. But even if you don't want to move this to this full extent with a passive program, I think you should at least, if you do think you can punt the market, consider this passive approach as the main bedrock of it. If you want to go and have a play with some pools or punt the market with a bit of grain on a spec, fine, but I'd argue you really shouldn't be exposing yourself fully to market movements. So, and again, why the worry? The study by Nivens and Carstens looked at 4 factors in terms of explaining profit variability, and the 2 key ones they found that had the biggest explanation for variation in profit were cost of production and adoption of technology, in this case no-till, which leads to yield improvements and also cost reductions because you don't have to go out and plough soil 5,000 times. So basically I'm arguing we should stop stressing about marketing and consider a passive style program for a portion of our crop, and as I said, dare to be average. Lastly, just like to acknowledge the support of Nuffield Australia and also my sponsor Macquarie Bank for the opportunities they gave me in 2009 to travel the world and look at global agriculture. And if any of you in the room have any or know of any young farmers, I'd only commend the program to you in the highest terms. Thank you.